All right, boys and girls, TMF is going to be printing some dollars again for us here, some more dollar hollers, because we just got the payrolls, numbers. By the way, before I go through that, McKay, did you get back all those bundle emails? Because I got to raise the prices.
Oh, yeah.
Okay, McKay says he got the bundled emails done. But we haven't raised the prices yet because we got to go to podcast, and it's like 5:37 our time. But anyway, so you have another maybe couple hours. Okay, and you can email us at staff@meetkevin.com if you have any last minute questions for financial advice or the courses on building your wealth. So what happened, folks? The big news is obviously the jobs numbers came out. Unemployment rate actually goes up 0.3% from 3.5 surveyed, 3.5 prior. People weren't expecting this. Goes up to 3.8. That is a 30 basis point increase, while average hourly earnings were expected to come in at 0.3, actually came in low at 0.2. In other words, the opposite of a wage price spiral. More unemployment, as why the participation number was moved up. I'll explain that in a moment. But at the same time, we went down from a prior read of 0.4% wage inflation, which would be like 4.8% per year, above the 3% goal. Went down to 0.3% in the survey, which would be 3.6% per year, also slightly above 3% inflation goal, right? The inflation goal of 3% is 3% for wages, which is supposed to bring in CPI at 2%. And then it actually came in at 0.2, which annualizes out to 2.4%, which is below the 3% target. So actually very good number there on average hourly earnings. That means average hourly earnings are still positive, but nowhere near that wage price spiral level. We also did get a revision down in the prior read, obviously in macroeconomic terms, especially with lagging data. These numbers always get revised down, but we got our prior read from 187 moved down to 157. That's 20,000 negative. This came in 17,000 hot though. Instead of 170, we came in at 187. But because the net number between those 2 months is negative, and we expect these numbers to move negative, and the unemployment rate moved up, the market is actually very happy about this. Again, the reason the unemployment rate moved up is because more people were deemed to be participating in the economy. Obviously, all these numbers are just a fancy estimate of what's actually going on, and there's some degree of variability and information that isn't accurate about it. But the prior read was a 62.6% read for labor force participation. That is exactly what the survey was. We actually ended up getting 62.8%. So more people participating in the economy, probably because you have to be able to survive. But that's also kind of the point. The Fed wants less people just sitting on a stack of cash, retired, not working. Then you have the average weekly hours of all employees. Usually when this number plummets a lot, it's kind of a red flag that, okay, businesses are like, no, y'all don't need to work that hard because things are slowing down. That number actually went up. So every read of this, to the extent that you could sort of trust these numbers knowing they're going to get revised, it's all good news. Like wage pressures down, job growth slightly down, but not like massively negative. The amount of hours people working and the number of people working up. All of those things are literally what the Fed wants to pause. That's what Jay Powell said. We need the job numbers to keep coming in this direction. If they don't, then we are prepared to raise rates more. As a result, because the numbers are continuing to come in the way we expect, we are now basically at a 90% chance of a pause for the September meeting coming up on September 20th. Mark your calendar for that. Mark your calendar for, I think it's September 13th. So in 12 days for CPI day. And then also mark your calendar for November 1st, which is the meeting that just had its odds of a rate hike decreased by about another 10%. So I think we're down to like 38% now chance of actually getting a hike in November, just because the data continues to show that, dang, it may have taken longer, but maybe inflation was the T word. Oh, we're not even going to say it. Of course, you know, nobody believes it. Nobody believes it until it's going to happen. And I actually think that, shout out to Christine Lagarde. She had a really good line about this. She said, look, inflation is understood in the rearview mirror, but it's felt forward. In other words, you don't know what's coming. You feel it. But looking in the rearview mirror, we look at inflation, we're like, yeah, makes sense. We printed way too much money. We had high inflation for a period of time thereafter, and then it would somewhat make sense that things normalize thereafter. But that does not change the bare thesis that the inverted yield curve signals a recession coming, whether it's shallow or deep, or that corporate profits, well, in many regards, are flat or negative year over year, or that maybe the lagging unemployment numbers and the true pain of unemployment is still yet to come. So let me know what you think down below. But the numbers we got today are definitely good if you are on the side lower treasury yields. Yay, TMF, or long stocks. Good luck out there. Thanks for watching. And yeah, go to a podcast. By the way, if you want to watch it, I don't know if it's going to be live.
I think so.
It might be live. You can watch me on Tim Pool's podcast. So we'll see how that goes. That should be really fun. But come add some support in the comments. See you there. Goodbye.